Hi, everyone. So excited to be here. It's Monday, beginning of the week, and I am so excited to get started. Had a tremendous weekend, had a great week before. Nice when momentum kind of lets you roll into the next situation without a lot of effort. Have my good friend and colleague Karl Dakin with us today. This is the funding show. Hopefully, this applies not only to people who are involved in funding, but people who are curious and may have an interest in funding down the road. With that said, the word of the day is due diligence. Again, it applies more than just funding, it's really about investigation, checking things out, learning more about situations before you actually press the go button. With that, like I say, chat's open. We depend on you to keep us as relevant and directed as possible. I'll switch it right over to Karl now. Karl's just an amazing individual I've been working with and has done some really cool situations with shows and newsletters. So I'll turn it over to you, Karl, and have you share a little bit.
Well, thank you, Don, for having me as a guest on your show here on Monday morning to help wake everybody up and get them started this week. For those of you who don't know me, my work is primarily in helping coach businesses and communities in raising capital, working through all the early elements of design, targeting of investor candidates, and trying to figure out how to craft offers that pair up best, like a good wine with a good meal. And in doing that, I have my own show on Tuesday mornings at 8 o'clock called The Successful Funding Show. And I've added to that another show of a group that I'm now teaming with and planning to spin out called RCI Community Funds. And the show is on community revitalization, where we're trying to help underserved, economically distressed communities get back in action. And I do publish a daily newsletter and a compilation once a week of that newsletter for those who can't get enough of me. So lots of opportunities to hear and see what I'm thinking, and happy to be here this morning to do it again.
Well, that's great. Always a pleasure to have you. And, the word of the day is due diligence. And might as well start off with some thoughts and insights into that. My initial thoughts are basically, diligence, I guess, comes from diligent, which means kind of like maybe a steady hand towards objective review. And, it puts some of the puzzle back into the right spot. Plus, a lot of due diligence will answer questions, but also raise questions. And by going through it all, there should be a level of confidence that at least, you're getting into something you're aware of. You've done some inquiries, and also you've shared what sensitivities you might have to the other side, which may allow them to bring more forth, knowing that that's a priority for you. And there's a confidence that comes with due diligence that makes you feel more comfortable about doing something versus just blind trust. So, in all your years of experience, Karl, how have you viewed due diligence over time to where you are now?
Well, due diligence is gathering information from somebody you want to work with. And as you're doing your own strategy, as you're trying to build your own plan and go to market, there are all these different things that you have to fear because they could take you down or slow you down, or in the concept of raising funding, these could cause you to miss your mark and miss the expectations that you may have created with investors in your company. So you do that for yourself, for your own company, and you assist investors in doing due diligence on you. But we had an example this weekend where we were looking to set up a sales distribution arrangement for a company, and we weren't certain what the strengths or weaknesses were of the manufacturer of this particular product. And without knowing these strengths and weaknesses, nobody wanted to commit to a large number of dollars investing in building a sales organization or to a long-term investment because they just didn't know. They go, is this something that could evaporate, disappear tomorrow? And this raised all kinds of questions regarding the intellectual property rights, the manufacturing capacity, the apparent questions regarding understanding how sales occur and what's necessary to make that happen. And so questions are now being asked. They're saying, these are not limited now to our four walls, but to whoever we're going to work with, because we're dependent upon them in order for something to occur. So we want to know what this is all about. And one of the challenges here, I think, is that um, you have your own knowledge and experience in which to frame your due diligence questions. But as we talk about, what you don't know can hurt you.
Mhm.
You may you may need to be asking questions you didn't think to ask in order to get to the issues or the threats and risks that you want to know more about, because you may not be able to fix the problem, but you then may also decide not to move forward with that project, or you get insurance or somehow allocate the risk to someone else. And I had an interesting situation this morning where, on another project, the New York Times posted an article where people are developing addictions to the sound of the voice of a chat bot or something like that. Like, I guess you could fall in love with Alexis or one of these things. And you're sitting there going, well, if that's deemed an addiction, if it's deemed harmful, what are you going to do to mitigate that? Do you have to create some kind of voice anonymous group, or have therapy sessions, or like a casino, put out things? If you have an addiction, maybe you should get in a group. These are all evolving things that nobody would have thought about a year or two ago, but it's a brand new market, brand new technology, brand new risk. So not only is your due diligence something you do at the outset of starting a relationship, but there is a need for maintenance due diligence, something that you periodically review, and looking at everybody that you're teaming with, and particularly anybody you're leaning on very heavily for your own success. You will kind of want to keep track of them. And I've talked about this a lot in the funding market, that supply chains, the person you're working with may be great, but the person they're working with may be the weak link. And you have to sometimes look through them and ask a due diligence question. Well, who are all your suppliers? Who are all your vendors? Are they all in good shape, or is something getting a little shaky out there? That you may again want to think about your own strategy in a prevent defense of let's get out ahead of the problem.
Okay, that makes a lot of sense. And I think the key point that, I'm picking up from this is what used to be more of a level playing field is totally unlevel based on all the other elements that weren't there before. So, if you go back a ways, there was no social media, there was no AI. There was, it was pretty, at the time, it didn't seem like that, but plain and simple, in that you could focus on what you were focused on, assuming most other things were constant to other businesses in that space. And now it's really about, how do you levitate in a way? How do you get above the crowd? How do you have a distinctive, differentiated voice and offering? And how do you continue to keep people excited and interested? Because value is determined by perception. It's not always just profit and loss or anything else. If people believe in the vision and they have some patience, well, that can go a long way towards having people more comfortable for the ride. Due diligence is really supposed to flush out surprises that you might encounter down the road. And the question becomes, whose responsibility is it for people to see it or understand it? And I think that's where, transparency and full disclosure goes a long way. Is, if it's there, why not put it out front versus hoping someone doesn't ask that question and have to deal with it. But you're dealing with people, you're dealing with finance, you're dealing with personal, emotional, and professional situations. And one person's needs and desires don't always match up with others. Some are long-term players, some are short-term players. Some are into what you're into, some could care less. And I think there's where a lot of due diligence needs to take place, is on chemistry and personality. Too many people focus on hard assets or resources or capabilities, but it's really, you're buying into the future, and what do you expect that let's say management team to do in the future? You're starting out from a baseline that they're presenting as either where they're at or where they've been and where they intend to go. But is there a confidence level in their ability to go to that direction? How do they pivot? How do they think? How do they change? And I think that gives people confidence to know, hey, this person's got a steady hand, done this 3-4 times, was very successful. Just makes sense they probably follow that with this. With that said, we've got Jason here. Good morning, all. Wishing everybody a wonderful week. I've got Kelly asking if we're live, so it's probably not getting to her. So here's Dennis. It is live. I'll stand up and you'll stand out, hopefully without a shout. Thanks, Dennis, for getting in there early in the morning along with Jason. Haven't seen Carrie yet. And Karl, how do you take that to another level?
Well, I think that today's volatility, fast changing environment requires that you set up sources of information. And there's different sources that can be out there, which can be your social media platforms where you get comments and questions and so forth coming in. I've set up Google alerts on a number of different topics that I want to make sure I'm hearing everything that's out there. I subscribe to probably about 20 different industry newsletters and news bulletins that come in, which is how I heard about the bot voice addiction. It caught me off guard, but it's because it was surprise information coming in through one of these newsletters. But one of the strongest sources of information is your community. And as we talk about building communities, you want to, I guess, create in the culture of that community the desire to help everybody else in the community by surfacing these kinds of issues, by kind of being an early warning system to the rest of the members of the community, so that if they see something that they think is going to impact somebody within the community, they do a shout out, they do a comment or a message that gets into the community communication channel to say, hey, look out, this is coming down the pike. You may want to take a look at this, and do it thoughtfully with an intent to be helpful and share within the community, so that somebody benefits, but potentially everybody benefits from having everybody looking out for your own back.
Yeah, I think it is a group activity, from a collaboration standpoint. And, I think that, the good thing about having people who are assisting you, and I think that's where Karl can play a important critical role, is bringing up areas that one should be discussing. So in other words, everybody looks at everything through their own eyes and maybe through their own experiences. But when you can blend that with someone who says, well, here's something that pops up to me, and it draws your attention to it, because a lot of times people are inundated with data, with just pages of stuff. And I know people, even with good intent, who are looking to raise capital, are always going to try and put their best foot forward. So they're going to try and really pump up the good things, the qualities. There's always that section of risks, and some of those risks are universal, acts of God, things like economy, whatever. But what is really the challenge, and a lot of times in due diligence, is too much dependence on one thing, one person, right? If all you do is have one client, Well, it's a kind of an absolute all or nothing. If all you have is one key manager with nobody underneath them, well, that's a pretty big risk factor. And I think the other thing, again, is the intangibles, like I kind of alluded to a little bit earlier, is how do people communicate? How open are they? How happy are they to hear questions? A lot of people are just like, I know it, you don't have to, or why are you asking that? And, when people expect people to ante up, write a check, hang in there with somebody, they deserve a certain level of respect and appreciation, especially if you're in a competitive market. The thing that will solve a lot of issues is more options, right? So if you've got 8 investments you're looking at, that are basically fit your criteria, things that are a little bit less satisfying become bigger issues. If it's all or nothing, and on the other side, if there's more demand, that impacts things too. So it works both ways. If you have more investment opportunities, you'll be a little bit maybe more particular. You won't feel so bad if you lose one. And if you have more people looking to invest bigger than you have capacity to, you'll probably be less inclined to go for the marginal individuals. And one thing I learned over time is when the check cashes, you're stuck with who wrote it. And too many people get caught up in completing a financing and not understanding what they're taking forward with them. And I think one of the biggest red flags were people who don't know anything about your industry, don't know anything about what you do, but they're enthused by it. They want to buy a ticket to it. And if they're going to be advisor on the advisory board or on the board of directors or whatever, that's going to be a challenge. It is like getting married, and you got to be at least have a good honeymoon. What happens after that is up to whatever. Looks like Carrie got on. Carrie, why did the vinyl go to therapy? It had serious groove issues. We've got the not sure what happened since your show won't play on LinkedIn. It took me forever to find it on YouTube. I don't know. Obviously, okay, here we go. Good morning, y'all. It's Kelly. I couldn't get the live on LinkedIn for some reason, but made it. I see you're coming in from YouTube, and I think that's a good thing to have that option when LinkedIn isn't doing it, or Restream. Obviously, it's working for some, but not most. What I would advise is refresh your browser. That could make a difference. But it's curious as to that. But that's the fun of live streaming, is you never know what you don't know until you know it. And then it's usually too late to do anything while you're live to change it, except give some reassurances. And that's the good thing about being on multiple times a week. It would be a shame if someone did a show every 6 months and that happened to be the day when the internet wasn't working or whatever. But I think that also demonstrates, even in a simple initiative like this, how things can go wrong where you have no control over or understanding. So Karl, what are the red flags that you usually look out for when you're doing due diligence?
Well, I'd like to start with management. You can have a great idea and have it unfulfilled or unrealized by poor management. And so I want to see who's the jockey who's running the show. And I want to look at their background. And background means, what's their history, what's their experience. And I'd like to get a handle on their integrity, their trustworthiness. And to some degree, I want to know about their tenacity. Because any business is going to encounter challenges. We see them all the time. I see them like every 4 hours in one or more of my projects. And I'm looking for people who are willing to solve the problem, not avoid the problem or duck the problem. And it's very important to me to know what their capability is. And sometimes that's demonstrated by experience in past projects on how they go about tackling problems. Some people like to point at others, or they blame others, or they just will not step up to the problem itself and take it on. And they're going to have a lot more failures, because solving problems is one of the keys to successful management. So I start with that, and if I think they know what they're doing, they look like they're good people that I can trust, that I'm a long ways towards buying into that project.
Okay. Well, I think that, that makes a lot of sense. Also, when you're putting something together, one may want to anticipate what due diligence is going to come from it or going to attract. And by answering questions before they're asked or in anticipation, we'll take some of that away from people. And I think that's important. And also by asking questions of the person, not just asking questions of the opportunity. So getting to know, how did you come up with these numbers? What are they based on? So not taking something at face value. And I think people respect people who investigate in a good way, who have quality questions, because the same questions that they're having for you, they're going to be having for other people like you. And if you have, again, a group of board of advisors or board of directors, you want to have harmony. You want to have collaboration. You want to have everybody pulling together the same way at the same time, as opposed to people who are just so into what they're into that they forget there's other parties involved. And plus, if you are conscientious and thoughtful, you want happy investors, you want happy boards, and how is that going to work out? Because the last thing you need is to get stressed from your group. And I've had different groups of directors and advisory boards, and early on, you don't know any better. You just assume certain things. And most of the things you assume is right based on common sense or logic. But, there's a saying, what's legal isn't always logical. And the same thing with investors. You would assume, well, based on this, you would be happy. And some people just aren't happy no matter what it is, forgetting about due diligence. So is someone bright in the room when they walk into it? Is somebody the one who will support you when there are questions, but believe in you enough to say, I'll let you finish what you're doing and then come back? Or how long will it take until we see what we've been anticipating? And that's what's important with really underselling and over delivering. I think when people raise the bar too high to get people to invest, and then they're stuck with performance, out of the gate is so important. If your numbers in the first 90 days or 180 days aren't matching, it only gets tougher from there. And the last thing you want to do is have issues outside of the company as well as inside the company. And then what could happen too is you start adjusting a strategy you believe in to create a more popular strategy that will gain you support, and you're actually going to lose both ways. So I think that's so important with investigation. Looks like today is National Vinyl Record Day, so maybe Kerry does get a head start on his jokes relative to what's going on in the world. Uh, so Karl, you were talking about your live stream shows and your newsletter, and how does I think that could be a major benefit to people who are learning or getting to know you for the first time. Gives you an opportunity towards credibility and trust based on what you write, based on how you speak, based on how you treat people around you. So I think that's important. And today we've got Cohen, and I can't tell you what a quality gentleman and colleague Cohen is. He participates in our cohort group, which takes place every other Thursday on Zoom. And by the way, I'm actively looking for people to qualify for what we're doing here. If you want to show, if you want to join our group, reach out to me. I'm very particular in that I'm only adding people who can add value and also return value to everybody. So it makes sense for everybody. Just popping in to wish you both well and pick up some wisdom. Well, Con, you are a purveyor of quality wisdom through your books, through your speaking, and really magnanimous and generous in spirit and in support. So thank you, Con. So getting back to where we were, which I think is where we ever are as far as new things kind of twist away from where we've been sometimes, but that makes it for being more dynamic and entertaining. Karl, what points can you bring about due diligence that we haven't covered?
Well, it's interesting. A lot of times when I ask a question in due diligence, I offend the person I asked. And even if it's something as simple as you framed it, like where did these numbers come from? It comes across almost as a personal attack on the person that's there. And you're simply trying to go beyond what you see on the surface to find out what's behind it. And you do need to do that. You can't take any number that's given to you by anybody and assume that it's correct. Even if it's correct at the moment, it may disappear tomorrow. What I have done, and our mutual friend Erwin Jack does, is come up with a basic set of questions that if you want to work with him, he says, please answer these questions. I have his questionnaire on my desk now, and I'm in the process of filling it out. But what he's helping do is saying, my question is pointed. It is going to ask what's below the surface, but that's not personal. This is just the way I do business. And these are legitimate questions. I ask them of everybody, and it diffuses any feeling that maybe I'm attacking them or their company, their baby, of their company. And I'm going, no. I ask this of everybody. If a relative of mine came to me and asked me, I'm going to ask the same questions, probably more questions, but I'm going to ask the same questions. And I think it's helpful for people who want to do due diligence to come up with their own set of questions that allow whatever opportunity they're looking at to match their business or their personal life or both, and to have that as a guideline or starting point. And by putting it out there that this is where we begin the conversation, people don't feel like you're reaching into their mind and asking for personal information that they don't want to share, and they don't feel that you're being offensive to them because you're asking really hard questions, because you have to. So I think it's helpful to create that kind of body of questions, have it ready to go, and then you tell people this is just basic information I need to do what I'm going to do in my evaluation. I think it's helpful that way.
Oh, absolutely. And, there is a balance of, really what it comes down to your ability to trust itself. If you're just asking questions and never satisfied and keep coming up with more questions, will that ever end? And there's a point, like I say, that everybody's got to trust each other to a point, at least based on experience and things that are objective. I always was a little bit affected by someone says, well, I did this before and it didn't work out. And I'm thinking, well, I wasn't there. I wasn't involved in it. I mean, so am I going to pay a price for a situation I don't even know of? No different if someone says, I'm going to invest because every time I invest, I make money, so it doesn't matter. And maybe sometimes that's not a bad rule of thumb. But again, it comes down to who you're working with, what's their background. Have you, that's the other thing. Talk to other investors or potential investors. Talk to people who've worked with them in the past. So, there's some validation and there's some understanding. And, results by themselves are not always directed towards the person who was in charge. Again, situations happen. How did they react to them? And also, what you can't see are the intangibles like culture. If I was going to invest in a company that, I had an interest in, I'd visit them. I'd walk the store, I'd walk the warehouse, or I'd go through the office, and I'd even ask, can I talk to a few people? Typically, you'd want to talk to the CFO or the financial person, or they would probably be involved already, but someone who's involved with HR and organization. Look at their handbooks, look at their manuals. Are they stringent? Are they too tight? Are they too loose? Is it a party atmosphere or is everybody solemn as you walk in? And, where's the energy? Where's the joy? Where's that coming from? And if you don't have that, you're leaving something behind. So I think it's really the balanced approach, the comprehensive look, and not the number or not the person by themselves, but what can justify something, what can compensate for something, and where is this going? And I think having a comparative to competition, right? So in other words, if you're in the same space, who is a big company that you aspire to be, and what's their value? What's smaller companies doing? And also, what is the lifespan of the idea, the concept? Is this the flavor of the day, or is this going to be here for a long, long time? And sometimes those numbers are affected by, could be a promotional campaign, right? Something went viral and everybody bought a million pieces, but you can't replicate it, And I think the other thing is, how does it scale? And what does it take to scale? Because as things change, it changes kind of everything. And what's the time frame? What's the pressure that's being exerted or not being exerted? So I think a professional like Karl could make that difference. And people are always looking at an expense instead of what could be an investment, could be risk aversion or mitigation. And I think people would rather lose a little and not hang in there for a long time, even if it's some due diligence expense. And there's also that strategy of getting you involved, getting you to start working the lawyers up, getting some bills going on, and then you feel committed, and it's too late sometimes to unstick the stickiness. You smile at that, Karl. Why?
Well, it's interesting because I do work with a lot of people who are going through due diligence, either to help present a pitch for investment, or people who are kind of ringing, may say, Karl, what do you think about this opportunity I'm looking at? And I'm not a wealth advisor, but I do have 45 years of looking at investments, and I have all kinds of opinions I sometimes share when doing that. But it's interesting that we're in a discussion this weekend. I was in all kinds of discussions this week, a very busy weekend. And we got into the maxim of he who has the gold makes the rules. I go, yeah, absolutely. But because he has the gold doesn't mean he knows what he's talking about. we got into this whole conversation that, yes, you get to say yes or no in this deal. You hold the ultimate decision making power. But before you make that decision, wouldn't it be nice to have a little more information to justify the decision? And if it's an individual, yeah, they don't have to report to anybody. But if you're in almost any other position, you're accountable to somebody, your shareholders, your staff, your team, your community, somebody. If you make a bad decision, and if you make it without enough information, then you're at fault. You're accountable for making that bad decision. So it is necessary to do due diligence. And it may take you 5 minutes to say, no, I won't work with this person. Good enough. Or it may take you weeks to dig through the information, look behind, check the markets, do all the other stuff. And you were mentioning everybody within the company to talk to. My favorite is go out and talk to the customers. So I like to show up in a trade show booth and start talking with the customers about the products, because their opinion, they're not always very good at explaining why they like or dislike something. So I kind of have fun figuring out what it is that caused them to make that purchase point. and use that then to help evaluate the company, where it's going and what it's going to do. Due diligence doesn't necessarily mean you have to reject something. It means you may have to make some fixes or make some conditions inherent in the deal to say, yeah, I'll go for it, but you got to do the following things. Like you need to get your books up so I can see them on a weekly basis, not on a quarterly basis. It's an adjustment. There'll be a cost associated with it, but you want that constant reporting process instead of here and there kind of process. So there's so many things to do, but it is in many cases it's an investment that will pay dividends immediately and long term, because every deal that you don't do, that you shouldn't do, you just made a fortune off that investment.
Those are excellent points. And, what it brings to mind is existing relationship will mitigate the amount of due diligence you have to do. And we talk about due diligence and investments, and that usually takes a lot of documentation, a lot of legalese, a lot of conditions, a lot of what ifs. But, most of my bigger financings were with vendors. And, I think that's a big question is what do you need? And do you have other sources that aren't as expensive as raising money? And again, who you're raising it with. So going back to that vendor example, almost everything was based on their word. You would say, okay, can you put it in a document? Could you just document it just in case? But if someone says, hey, I got $1 million worth of this, I got to have an answer by 5 o'clock today or it's going somewhere else, right? And you would say, well, what are you going to do to help me out here? Because where we made out, and where a lot of companies can make out, is we were able to make a decision in 10 minutes and write a check in 10 minutes. And at the end of a quarter, or at the end of the year, even more importantly, we would get a call by the national sales manager or a regional guy or even a sales rep. Hey, we got to make our numbers. We got 2 days and we need $400,000 worth of business to hit our mark, which is usually a bonus or some incentive they're getting. The question is, I don't need $400,000 in the next 2 days. So what could you do to make it easy for me so I can make it easy for you? And someone would say, at the best case, we'll just guarantee the sale, which means take it in. If it doesn't sell, we'll pay the freight back, or pay as you go, which would be more of a floor planning situation. As you sell it, pay for it. That way you're not taking a risk and you're helping me out. And if you need some more help, I think I can work that out. And that was the give and take, but those are in continuing relationships where everybody has a vested interest in each other, versus someone who sends money to you and now you convert it into the business, and hopefully in time the business will convert it back to them as far as a return or a nice upside. But if you're not working your business, you can't expect to work investors because of your lack of understanding or initiative. And people like innovation. People like, well, you're financing your business with payables, right? And your cash flow is strong, because what you don't want to do is go back to the table and say, I need more sooner than I thought. Because at that point, well, there's going to be a discount typically, and your credibility and confidence has been diminished unless you have a compelling story that says, well, truck fell into the ocean, and hey, what are we going to do? And I think those things are just part of business and part of life. And I think, to Karl's point, reporting is so important, because nobody likes surprises, especially ones you already knew about. So I always felt as soon as I knew, everybody should know, because it says I'm getting out in front of this. I'm not going to hide something. I'm not going to polish something more than it is, because it will continue, and those false or phony excuses won't last long. and you're just digging yourself a bigger hole. So we talk about the negative because the positive, you write a check, you go to sleep, you wake up, and you got all your money back and more, and nobody had to even do anything. That happens very, very rarely, but that could be a possibility that I wouldn't really bet on. And it's the fun of being part of something. And I think that also goes with believing in what the product is and what it does. There is a cause to everything. Sometimes it has very little value, the cause, and sometimes it has tremendous value. And some people just want to help people they feel deserve that help. I mean, I've had investors, when I asked them why I do, they said, well, you're a good guy. I believe in you. And, I can afford it. And I think Karl made that point the other day is if you have limited resources, be very thoughtful. I saw an article actually on Charlie Munger and Warren Buffett over the weekend. And both of these guys, if you don't know them, they're among the richest. Charlie just passed away, but 125 billion dollars of personal net worth. And what they both said about money, they said it was overrated. Their goal as they became older is not how much money they had, but how many people loved them in their life. And that's how they quantified success. And your legacy grows beyond you when you get people going into things, when you help people out. Because I've got mentors and people who came to my aid without understanding why or why me. And I'll always be grateful to them, and, I mean, those are kind of intangibles. But wouldn't it be fun if someone did come to your aid and then became a continuing partner and support mechanism? Because a lot of times they have a bigger, stronger voice than you do. And if they said, I'm in, most times people say, well, if Warren Buffett's investing in this, I think he did his due diligence or felt he didn't have to. And you could follow the lead of a main player versus dealing with everybody equally. So what's your thoughts on that, Karl?
Well, they often, the statement is the first investor is the hardest investor to get. First dollars are hardest to raise. And part of that is because that person is doing all the due diligence. They're asking all the hard questions. And if you don't have the answers immediately, you have to go out and get the information and get it over to them as very, very quickly because it won't sit around forever. And after the first dollars come in, most people who come in after that are assuming that the first person did all the due diligence and they don't have to. I'm a member of the Impact Cherub Club, which is doing small dollar investments in investment crowdfunding campaigns. And we rotate responsibility for doing the due diligence on different projects so that not everyone has to go through that long process of doing it. And I'm doing one for a community building right now. And I'm just so happy with the project because all the information is there. I don't have to go digging. I don't have to worry that something did or did not happen because they've done a really good job of getting the information ready to review and answering all the questions in advance. But yeah, all too often I will see the second, third, or fourth investor come into a deal. And when I talk to him, I says, well, how much due diligence did you do? I didn't do any. I just saw that this guy invested first. And if he's investing, then I assumed everything's okay. Well, that's not always true. The first investor through the door may be investing for the wrong reasons, have wrong expectations, may have not have done any due diligence. So a little word of caution: if you're a follow-on or piggyback investor, you should talk to the first investor and do due diligence on what they did due diligence on, because you can be surprised quite fairly. But yeah, if you've got the information, that allows you to make decisions. And as you stated early in the show, the more information you have, it's easier to differentiate between one investment opportunity and another. This one may, have 4 or 5 things you like. This one may have a different 4 or 5 things that you like. But if you ask more information, then you pick up 2 or 3 things that maybe you like or dislike about one or the other of the investment opportunities, and you'll go for the one you like most. And making blind decisions without doing due diligence, it's a surprise. And you use the term gambling or placing a bet, on these deals. Well, that's exactly what you get when you invest without due diligence. You're gambling. You're saying, hey, they had a pretty logo, they had a beautiful slide deck, they choreographed that scene really well, or they had a celebrity that was standing with their arm around the guy. None of those mean anything to the merits or substance of the deal. That's just slick salesmanship. So do your due diligence. Don't be surprised. Don't make bets. Get in there and ask the questions that are meaningful to you. And we're seeing a trend these days that you mentioned also earlier, that people are now looking for purpose. They're looking for impact. They want their money to do more than make money. And the younger generations, this is almost putting purpose ahead of profits, as it's described. And so what we've seen in a lot of due diligence reviews recently is, what is your ESG card, your scorecard look like? What are you doing for your community, for society, and so on? And if you don't have that information, then they're going to pick somebody over you because they want to see that kind of information included, and you have to supply it. And it's very important that you think in terms of what do the investor need to see, have that information ready, have it 1 or 2 levels of detail, maybe more than they're going to ask, so that they can see how thorough you are, and get that all ready to go. And that's part about what we call getting ready to receive capital, is anticipating the questions that you would receive from investor candidates through a due diligence process, putting them in a neat, orderly fashion so you can answer questions as they come in. And to your investor, that just elevates your credibility because you've anticipated their question. That means you respect and understand where they're coming from. You're prepared, which means you're a competent business person. And these all work toward your benefit in getting the highest score. With the Olympics now over, everything is being scored everywhere. We're seeing all the comments, but that goes also for due diligence. Are you going to get a high score or low score?
Yeah, those are great points. And what it brings to mind is due diligence, and that whole process of reviewing investments is a precedent, of things to come and positioning one. So if someone says, I don't care, it doesn't matter, whatever you do is okay, is that who do you want to bring along? Now, if you're just looking for sheep who don't question and follow the lead, maybe that works. But if you're really interested in involvement and participation and knowledge, what do they bring to the table? And a lot of times the questions are important questions that the person or the group didn't realize when they put it together. So what's a red flag for you probably is a red flag for the company and them if they haven't done that. And, I would rather have more sophisticated people that you don't have to continually explain everything to, get them up to scratch, because when you leave them, they're back at the bottom again, having to be raised up. And there is a certain responsibility investors have to have in order to be a quality investor and be someone that the group feels is an asset. And at that point, pricing changes too, possibly. Because if the right person comes in with the right resources or referrals or network, well, there's a premium to that person over someone who writes the same check and becomes an issue with you or everybody. And some things to be true that aren't explainable in a way that everybody can fully understand it. You can go into multiple levels of detail and maybe, convince people, but you shouldn't ever have to be in the convincing mode. You should just be in the transparency mode that here it is. If you need more help, you can always go to a professional advisor, go to your CPA, go to your lawyer, go to your whatever. and get that and get some verification outside of the company. And I agree with Karl, because a lot of times whenever I had to do financing, they would ask you, give me your top 5 suppliers and who can I call there? And at that point they would just say, okay, well, here's what they think about you. And based on that, I gained some confidence. The other thing I think Karl brought up was the lead investor. I did a lot of turnarounds and restructurings, and one of the key elements was creditor groups. And there was always a lead creditor that the rest of the creditors would defer to. It was usually the biggest creditor or the person who had the most experience in credit resolution. And once you won them over, everybody followed suit. The nice thing is you just had to keep them wowed and won over, because there would always be accommodations, right? You start out with a plan and somehow something would change and you'd need an adjustment and have to go to everybody to sign off on it. And usually when you had a group, that was all you needed, because everybody would follow suit at that point, and they would help you. A lot of people who maybe give people pause are really doing you a favor if you allow them to. So what's usually good for them is good for you. But I know that fairness and treating everybody equally, because I found so many people will help you if you're helping yourself. If you go into a restructuring group and say, I need this concession, I need this accommodation, and they're saying, what are you going to do? What is the company going to do? Is it going to lower payrolls for management? Is it going to decide that we're going to compress and just get to where we're the strongest and get rid of these outside things? And the same thing in investments is like, why? The what is easy to understand. The why takes a little more time and support. You're going to open 20 stores next year. Well, what cities are you planning on opening? What are you waiting for to open the next one? Just have you thought this out? Or is this as it goes? Either way has its benefits to a point, but again, what is priorities and how seriously do you take them? What are secondary things that you can experiment with? And really, where is money going? Where is money intending to come back? Because a dollar in has to be leveraged against a dollar out. And I think, burning cash or cash burn is important. You might have a great company that even makes money, but is behind the curve when it comes to paying its bills. And that could be carrying too much inventory that doesn't sell, not having the right margins, not having the right cost structure. There's so much to it. And I think if you are concerned, and everybody should be, because Karl's right, it's the decisions you don't make that can save you more money than the decisions you make. And why not have 1 or 2 quality investments, then spread it around everywhere? Plus, the question is, how much can you keep up with? How much do you need to allocate as far as time? And that's an important element. If people are doing the right thing, let them alone, support them, promote them. It should, the due diligence should stop at a certain point, and the coming together collectively to make it happen should begin. And you can be responsible for a company's success in some way or its failure in some way. I have people come in on the board, on my board, and they fly in from a different part of the country, and they read an article on the plane. Well, this is what everybody's doing. Well, we should do that. And then the rest of the board, hey, that's a great idea, Charlie. And I'd be saying, yeah, great idea. None of you guys are going to be involved with figuring it out, launching it, or taking care of it, because when you get back on the plane, you're back in your world. But again, that doesn't always have to be the case. More questions that are relevant are good questions. Questions just to poke at something and see what it is, you're starting to take a lot of time and attention. And plus, everybody will say, hey, that person's trouble. You can tell them a mile away just the way they approach things. So having somebody who can really qualify people early in a just manner. And a lot of times experience and wisdom goes a long way because you can relate it to, I remember 15 years ago, a guy like that showed up with the same approach, and this is how it worked. Not to say everything duplicates itself over time, but something makes you uncomfortable. And I think it works both ways. As an investor, that answer didn't make a lot of sense, or I just don't feel good about it. And from the company standpoint, it's like, hey, at a certain point, you got to have enough going for you to be in the group. So, how do you really qualify people in sometimes not the most timely situation in order to qualify or disqualify somebody going forward?
When I tend to, what we call, your first impression is the most important impression. And I'm like everybody else. So the first conversation I have with someone, I'm automatically drawn upon all my experience, all the people I've known, and I'm assessing value. I'm judging them. I'm doing all those things that you get yelled at for, but I'm making my first decision on them. And from there, I'm going to start asking questions to see if my impression is correct, or maybe I'm getting ahead of myself. And so sometimes I ask questions which don't seem to be tangent to what we're talking about, but I'm trying to figure out what I'm seeing. Is it the real person? Is the depth there to that person? Where are they coming from? And I have a stock of questions like, for an investor, sometimes I go, "What'd you do this last weekend?" If they tell me they were working in a soup kitchen, doling out soup to homeless people, I put them in one category. And if they tell me they had their jet skis out at the lake, having fun, I put them in a different category. And I may choose not to work with them as a consequence, because I like people who think systematically. I think they work at a community level. They're taking in effect, the entire context of the world, and not being too singular, overly focused on one thing, which may or may not turn out to be the pivotal issue to talk about. But one thing that I think you should do is, if an investor turns you down, you need to do your own due diligence in reverse. You need to ask them, why did you turn me down? And not turn it into a hostile confrontation, but go, what could I have done better? What would have made maybe a difference, and make them an advisor to you. And too often you're going to hear the words, somebody told me this or told me not to do this deal. Could be a wealth advisor, their attorney, their accountant, or somebody else. And you realize that while the person you're talking to is doing due diligence, all these invisible people surrounding them were doing their own due diligence, and somehow you didn't meet their requirements. And so the person who's in front of you didn't really make the decision. They relied upon somebody else, and you never got a chance to talk to them or deal with their issues. So the due diligence is broader than what you're getting in front of you, and you have to take that into account. And debriefing people who turn you down in a positive fashion can often glean out that information, get you information that helps you make your better presentation, build your due diligence war chest a little bit stronger, a little bit broader, to answer questions going forward.
Yeah, that's important, very important, because what comes to mind, and I agree with you on the debriefing, is some of that could take place during the due diligence, right? So,
Should.
and as a, let's say, company who's looking for investors, there's a basic amount of information you just have to provide. After that, you can personalize it, and you probably should, right? Because sending people on here's my last 20 commercials that we ran, or TV ads, is like, yeah, but so what? It builds it, it's fluffy, it might be attractive, but really understanding what is it that person's main focus is. To your point earlier, is it cause-based? Well, and to what extent? Because at a certain point, you can go too much into cause and get away from the business or the profitability factor. And how do you communicate now is a big question that wasn't there. To me, if someone's not motivated towards integrating a live stream capability, then they're probably leaving a lot behind. And where they've competed were with companies who were at that level of proficiency or vision. Someone comes in and harnesses AI, someone harnesses social media, someone harnesses live stream. Those are game changers. You could take a moderate or mediocre business model and really blow it up based on the easy exposure that they can get, the free exposure they can get, bringing in all of their people. I know Harvey Tuck with his franchise show. Why not bring leaders to the table together? Why not bring the best customers you may have and leverage them up? Why not take suppliers and recognize them? There's so much you can do with your basic model to let it expand by leveraging a bigger platform, bigger numbers. And that could be the difference in marketing expense. And plus, the more you're cutting edge, even though you may not be as cutting edge as the vehicles you're using, that becomes attractive to investors, right? When people used to ask me about my company, when nobody knew my company or could know my company, I said, well, I'm just a factor of being associated with Google, Microsoft, Amazon, Walmart, UPS, everybody who I had a tight relationship that was really supporting me. Well, if you don't know me, you know them. And I'm working with all of them. And as they grow, as they change, and there's more innovation, I'm going to get the benefit. And it shows you can build long-lasting, strong, strategic relationships with larger groups and companies. Sometimes all you got to do is be a little bit of a big thing to really have something significant. And that Microsoft will be here for a long time, and Amazon. So somehow, to your earlier point, they did some due diligence or they have some experience. And why did they elevate you to this high level of being a valued client? And what vested interest will they use to continue to support you in ways that won't require financing? And I think the key is taking your business model and showing where it could move to based on things you're related to, not just your core competency or your business. But I see we're already at an hour and 2 minutes and we just got rolling. We haven't even gotten into second gear. But because of that, we'll be back on Wednesday for another funding show. I really advocate you visiting Karl's show, which is on LinkedIn. You can catch it on his profile. It precedes this show by an hour. And Thursday's show is very, very innovative and exciting because it's relatively new, has new players. You can see how it can grow and change along with the people in it. So yeah, if you have an opportunity, you're interested in live streaming, check out Karl's shows, check out Karl's newsletter, because you'll learn something. And that's maybe due diligence in your approach to getting onto live streaming yourself, finding better ways to communicate, complement what you're doing, not always having to replace it. And the other added benefit is I know Karl as well as me are very open to outside communication of the show. So if you're interested in what we're doing, how we're doing it, if we can be of some help, happy to have a 15-minute Zoom call and help you that way. So Karl, last words for today.
Yeah, I think that we've set the table for Wednesday. We basically have opened up about 100 new things to talk about. We'll see how many we can get through in a couple of days, down the road. There are just so many different things for people to think about in positioning themselves either to receive money or to make investments. And it's important to use the tools that are available, the newer tools that are more efficient, like LinkedIn Live. because you reach so many more people in such a higher quality presentation that it reflects on you and your ability to use your resources well, which is both good from an advisory standpoint and also good from a small business who's trying to do better.
Great. I couldn't have said it better. And with that said, thank you, audience. Thank you for everybody who's seeing it, but we're not seeing you. I know we've got like 20 some people watching this show right now. Apologize for any issues that Restream LinkedIn or possibly I had something to do with. And I think that's important too, responsibility and accountability. So with that said, have a beautiful day, a wonderful week. Come back tomorrow. Tomorrow we're going to have a very cool show. I think for the first time in a long time, we're going to have Beverly Glazer with Kelly. And Kelly will also be here Thursday. So it's almost like a checkerboard. We've got Karl Monday and Wednesday, Kelly Tuesday and Thursday. And, it's only going to be more fun and exciting. So again, thank you. Hope you get as excited as we are. It's going to take a while to calm down now with all this enthusiasm and excitement that's been generated. But we're